Hey everyone, welcome back to Corporate Decoder. Today, Innovative eSolutions and Support Incorporated ISE just dropped their Q2 filing for March 2026, and I am seeing some big moves here, especially with those recent acquisitions. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just bought some serious assets from Honeywell and Moog, and it is changing their financial picture quite a bit. Let's dive into what that means. So Innovative Solutions and Support Incorporated, or ISE, just filed their quarterly report for the period ending the 31st of March 2026. This is where they lay out all the financial nitty-gritty. Let's kick things off with the balance sheet, which is like a snapshot of what the company owns and owes. At the end of March 2026, their total assets jumped up significantly to over $138 million. That is a big leap from about $103 million back in September 2025. What is driving this jump? Well, a huge part of it is Goodwill. You can see that Goodwill went from about $6.7 million in September 2025, all the way up to nearly $15.8 million by March 2026. This Goodwill is basically the extra money they paid for businesses over the value of their identifiable assets. It signals those recent acquisitions we saw mentioned. Their intangible assets also more than doubled, going from about $23.6 million to over $46.9 million. This is likely due to those new brands, licenses, and customer relationships they acquired. On the liabilities side, current liabilities, which are debts due within a year, stayed pretty steady around $16.5 to $16.7 million. But their long-term debt, the money they owe over a longer period, that is where we see a massive change. It more than doubled from roughly $21.7 million to over $49.2 million. This increase is directly linked to those acquisitions as they took on more debt to finance them. And with all these changes, shareholders' equity, which is what the owners effectively have in the company, also saw a healthy climb from about $64.6 million to over $72.1 million. Now, let's look at how the company is performing financially, the income statement. For the first quarter of 2026, net sales were up a little, about $22.4 million compared to $21.9 million in 2025. But over the first 6 months of the year, sales saw a much bigger jump. They went from about $37.9 million in 2025 to over $44.1 million in 26. That is a jump of about 16.5%. This increase in sales definitely helped their gross profit. For the first 6 months, gross profit went from $17.9 million in 2025 to almost $23.3 million in 2026. That is a really strong improvement. Their gross profit margin also improved significantly, climbing from 47.2% to 52.8%. This means for every dollar of sales, they're keeping more money after paying for the direct costs of making their products and services. However, one area where spending really shot up was research and development. For the first 6 months, R&D expenses jumped from about $2 million in 2025 to over $3.1 million in 2026. As a percentage of sales, R&D went from 5.3% to 7%. This shows they are investing heavily in new products or improving existing ones. Selling, general and administrative expenses, or SG&A, also went up. For the first 6 months, it rose from $7.6 million to $9 million. This increase is likely tied to those acquisitions they made, carrying costs associated with integrating those new businesses. Despite the higher R&D and SG&A costs, that jump in gross profit kept boosting their net income. For the first 6 months of 2026, net income was $7.5 million, up from $6.1 million in the same period of 2025. That is a solid 23% increase in profit. Looking at the statement of shareholders' equity, we see how the owner's stake in the company has changed. We already talked about the overall increase, but it is important to see that the company is issuing new stock, which is common when they make acquisitions or have stock-based compensation plans. The expenses related to share-based compensation, like stock options and restricted stock units for employees, have also gone up. For the first 6 months of 2026, it was about $1.4 million, a big jump from $801,000 in 2025. Companies do this to attract and keep top talent, but it does dilute ownership over time if new shares are issued. Now, let's dig into the cash flow statement. This tells us where the company's cash is coming from and going. For the first 6 months of 2026, cash from operations was about $10.4 million, up from $3.1 million in the same period of 2025. That is a really good sign, showing the core business is generating more cash. But, as we suspected, investing activities show a massive outflow of cash. They used over $35.7 million for investing activities in the first 6 months of 2026. This is almost entirely due to those acquisitions. Buying Honeywell's autopilot business for $22 million, the Honeywell generator business for $8 million, and the Moog autopilot line for $3.5 million really drained their cash. Financing activities are also showing significant activity. They brought in over $29.3 million in financing for the first 6 months of 2026. This is mostly from drawing down their delayed draw term loan, which they used to fund those acquisitions, so they borrowed money to buy these other businesses. Despite spending a lot on acquisitions, their cash on hand actually increased. Cash and cash equivalents at the end of March 2026 were over $6.7 million, up from $2.6 million in September 2025. This means the cash generated from their operations was enough to partially offset the acquisition spending, and the new debt helped bridge the gap. Let's talk more about those acquisitions. On the 27th of March 2026, they bought assets from Honeywell related to autopilot and avionics systems for $22 million. Then, just a day later on the 28th of March 2026, they bought more assets from Honeywell for their generator and control units for $8 million. And in February 2026, they bought the S-Tech autopilot product line from Moog for $3.5 million. These are significant moves that clearly reposition the company. These acquisitions definitely boosted their intangible assets. For instance, the Honeywell autopilot deal added $18.1 million in intangibles, including backlog, customer relationships, and license agreements. The Honeywell generator deal added another $4.35 million in intangibles. The Moog deal added $1.89 million. That is a lot of brand value and future business added to the books. And with these deals, Goodwill also jumped significantly. The Honeywell autopilot deal added $3.8 million in Goodwill, and the generator deal added $3.65 million. The Moog deal added another $3.81 million. This reflects the premium they paid for these businesses, likely expecting future growth and synergies. To finance these deals, they heavily leveraged their new credit agreement. Back in July 2025, they secured up to $100 million in credit, including a $45 million delayed draw term loan. This is what allowed them to fund these acquisitions. It is a big change from their previous credit line. Looking at the operational performance comparison, net sales for the first quarter of 2026 increased by 2%. That might seem small, but it's driven by a strong $4.3 million increase in commercial aftermarket product sales. They also saw a slight increase in business aviation sales. However, military product sales decreased noticeably, likely due to that transition of F-16 production. Services sales also took a dip, mostly from lower volumes in some acquired product lines. Cost of sales as a percentage of net sales stayed pretty stable at around 48.9%, but gross profit margin actually improved slightly to 51.1%. This is a bit counterintuitive given the decrease in services sales, but it is likely because of that strong growth in higher margin commercial aftermarket products. The research and development spending really stands out. It more than doubled in the first quarter, making up 8% of net sales, up from 4% in the prior year. This suggests a major push towards developing future products, which is usually a good sign for long-term growth, even if it impacts near-term profitability. SG&A expenses saw a significant jump of nearly 39%. A big chunk of that increase came from employee-related costs, and so-called one-time charges related to those 3 acquisitions. As a percentage of net sales, SG&A climbed to 21% from 15.6%. This increased spending suggests integration costs and expansion efforts are underway. The total income tax expense increased, and so did their effective tax rate. For the first quarter, the effective tax rate went from 19.2% to 22.6%. This rise is partly due to state income taxes and a higher overall income before taxes. The net result of all these factors is a decrease in net income for the first quarter. It fell from $5.3 million in 2025 to $3.4 million in 2026. This is mainly because of that significant increase in R&D and SG&A spending, even though sales were up. Earnings per S-Hair on a diluted basis dropped from 30 cents to 19 cents. Looking at the 6-month period, the picture is much brighter. Net sales increased by a strong 16.5%, reaching over $44 million. This is fueled by a hefty $9.9 million increase in commercial aftermarket product sales. Services sales also grew, showing the broader positive trend. Cost of sales as a percentage of net sales actually improved significantly, dropping from 52.8% to 47.2%. This is a big win. It means they became much more efficient in producing their goods and services, and that higher margin sales mix is really paying off. Consequently, gross profit for the 6 months saw a substantial increase, rising from $17.9 million to $23.3 million. Their gross profit margin also saw a massive jump from 47.2% to 52.8%. This is likely the most important indicator of operational improvement in this filing. R&D spending also increased for the 6-month period from $2 million to $3.1 million. As a percentage of sales, it went from 5.3% to 7%. Again, this shows a commitment to innovation. SG&A expenses increased by 18.4% from $7.6 million to $9 million. Again, a good portion of this is linked to those acquisitions. However, as a percentage of net sales, SG&A remained relatively stable, around 20%, which is a positive sign. Income tax expense more than doubled for the 6-month period from $1.5 million to $2.8 million. The effective tax rate also increased considerably from 19.2% to 27.3%. This is a significant jump that warrants watching. Part of it is due to higher income before taxes, but other factors like state taxes and non-deductible expenses also played a role. Despite the higher tax burden, net income for the 6 months ended March 2026 was $7.5 million, a solid increase from $6.1 million in 2025. Diluted earnings per S-share also rose to 42 cents from 34 cents. This shows that the overall growth in sales and improved gross margins more than compensated for the increased R&D, SG&A, and taxes. Let's get back to cash flow. The company generated $10.5 million from operations during the first 6 months of 2026, a great improvement over $3.1 million in 2025. But that massive outflow of $35.7 million was for investing activities, primarily those 3 key acquisitions we've been talking about. They also spent money on an Eclipse business jet for research and development, plus facility and equipment upgrades. Financing activities provided them with $29.3 million. This came from borrowing money through their delayed draw term loan to help pay for those acquisitions, though they also made some payments on their term loan and paid taxes related to equity awards. Looking at their backlog, which is the value of committed orders yet to be filled, it has grown. At the end of March 2026, the backlog stood at $87 million, up from $77.4 million in September 2025. This is a healthy sign, indicating strong future sales potential based on current orders. They expect to recognize about 67% of this backlog over the next year. So what is the big picture here? Innovative Solutions and Support Incorporated is clearly in a growth phase, fueled by strategic acquisitions. They bought significant product lines from Honeywell and Moog, which adds to their revenue potential and market share. The balance sheet reflects this aggressive expansion, with higher assets and substantial new debt. While the short-term impact of these acquisitions and increased R&D spending hurt their first quarter net income, the 6-month results paint a more positive picture. Improved gross margins and increased sales show the company is becoming more efficient and is capturing more market value. The biggest risk I see is managing that increased debt and integrating all these new businesses smoothly. If they can effectively leverage these acquisitions and continue to innovate with their R&D investments, they have a strong path forward. What I'm actually looking for is how well they can turn these acquired assets into profitable, higher margin revenue streams in the coming quarters. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and check the Discord in the description.